Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And tonight, a quick video, keeping this one on the shorter side, but just had a couple charts, such as our inflows of metal, alleged inflows of metal into the ETFs like GLD and SLV. The reason I say alleged, I could give you some folks who would make a strong argument that the metal isn't there or when called upon won't be there. If you watch the show regularly and know Dave Kranzler, who I have on weekly, he's written a paper a couple of years back about his concerns. For what it's worth, I actually did call the folks who run SLV. I forget whether they're called BlackRock or who it was, but verified with someone at least that they're advertising that as metal goes into these trusts, new shares are created. So theoretically, if you were to redeem metal, which can only be done in large blocks, but theoretically, if that is actually done as stated, then the metal would be there. So that's what they say they do. I would say outside of short-term trading, I mean, gee, if you really have some strong feel on a bet over the next week or two, then by all means, use some of the ETFs. Although if you're really looking at bullion as a form of savings or protection against dollar risk, just seems like an unnecessary risk. Of course, if you buy physical premiums, when you get in and out of that, the spread is wider. So if you thought gold was going to go over the next 2 weeks, you probably wouldn't want to buy physical and then sell it because you're going to have a certain amount of friction just in those transaction costs. But anyway, a few thoughts on the ETFs. And with that said, let's kick into the action here. You can see this is the gold ETFs, primarily GLD. There are a few others. And really over the last month and a half, let's see, I count 7 bars there. So 7 weeks. You had this big spike, which was a real thumper. But even these ones, looks like last week, 2.3 million ounces. And if we look a little farther back, here is the 10-year chart. And you can see, obviously, that spike a couple weeks back was almost at least double, may if not triple. That looks like just under 8. And here, just about 2. So even though now that was only 1 week and it's cooled off since then, but you had a couple weeks. It looks like the 2 weeks surrounding right there where you had about 3.5-ish, maybe 3.4 in that one. But still, historically, a lot of metal going in there, not for completely mysterious reasons. Federal Reserve running unending quantitative easing. Um, and still, I don't know that they've really resolved the problem through all of that. Even despite that, we're going back. Stores are opening up. Nasdaq at new all-time highs. So I think there's going to be a lot more money coming. This is just the beginning from the Federal Reserve, shocking as that may be. How has silver reacted? Well, after a little bit of a withdrawal the previous week, back up to 10 million ounces. And again, I know that it's easy to lose track of the scale of these things. So that's why first, I want to take a look back here. Here you see, now there have been some months or weeks rather, we've had some big spikes. Here's one in 2013, one in early 2011, a decent one 2009, this one way back here, which I guess that would probably be when SLV was seeded in 2006. I would imagine would be that spike accounted for there. So maybe not the all-time highs, but still some significant chunks like this one a couple weeks ago where it hit over 25 million ounces in a week. And to put this in perspective, I have a clip here, and I'm going to see if I can work Zoom. And wait, no, and we're going to get it so it actually captures the audio of Actually, something from the book that I just released, The Big Silver Short, where there was an interview with Ted Butler. And I remember it was interesting because he was talking about the amount of metal that went into these same ETFs back in 2010 when Ben Bernanke was launching QE2, and the impact that that had, leading to, he felt that was the main driver leading to the $50 silver. And then when you hear the amount that went in there compared to what we already have now, which is well over probably 150 million ounces in the last year. But let me stop talking, and here you can hear it directly from Ted. But again, if you can go back maybe to 2010. All right, maybe I'm going to ask the question. Then you'll hear it from Ted. That was happening. You mentioned in one of your articles that you were seeing physical tightness in the market. I was wondering if you could describe what that actually means and looks like.
Sure. It's important to keep in mind that silver is a very unique commodity in that it's both a industrial commodity and it's a investment asset. And the physical shortage that was started to develop in the fall of 2010 as we were hitting and moving above the $20 mark for the first time again since both 2008 and before that 1980. There's a funny thing about investments in that people collectively buy things that are going up. You know, we go to Kmart, we go to Walmart. You know, you're looking for a sale, a bargain. When it comes to investments, that rule is thrown out and reversed, and people buy only when the price of something is going up, whether it's stocks, bonds, real estate, silver. It doesn't really make, there's no exceptions to it. So back in the fall of 2010, when silver started to go up, it started to attract not greater industrial demand. That doesn't change that much, okay, right, from day to day or even from year to year. What starts to change is investment demand, and the price is going up. People collectively buy. I know we're supposed to buy low and sell high, but that's in the books. So what we do in real life is the opposite of that. We buy as things go up, and we sell as things go down. So as silver prices were starting to go up in the fall of 2010 to new highs, it generated investment demand. And because we had by that time established the big silver ETF, SLV, which came about maybe 4 or 5 years prior to that, a lot of demand, it's an easy way to buy silver, so a lot of demand, investment demand, started coming into SLV. And as a result of that paper buying of shares of SLV, the way the trust works is that all new buying has to be satisfied with physical metal deposited to match the new shares created. And something like 60 million ounces was bought collectively in SLV in a few months period of time prior to the price peak. And I contend that it was that buying of 60 million ounces and the deposit, the physical deposit of the 60 million ounces, that contributed greatly to the physical silver shortage. At the same time, Sprott was coming out with its physical silver ETF, adding more pressure and demand for physical.
So I'm going to pause that there, if I may. Again, this is on my channel, Ted Butler on silver shortage of 2010, 2011, July 26, 2019. But what I want to take away, hopefully you heard at the end there. If not, even go back and review it a second, because he talks about, here you have 2010 to 2011 when Bernanke was giving his op-ed about here comes QE2, and you had the blue line here. So you had about 60 million ounces go in, and that you saw, again, Ted's opinion, who I think is far even more qualified than me to speak to that. And he felt that caused that spike. And when you take a look at what happened just in the last year alone, when we went from about, yeah, I ballparked 150 million. It's been a while since I counted, but it was right around slightly over a billion ounces here. And that's around May, June of last year when the rally begins. Again, you can see large chunks of metal going in. And you saw also, it doesn't look quite as dramatic with 2011 in the scale, but there was the rally last year. Um, and so another thing worth pointing out, but again, actually, just to be clear, so you had about 200 million ounces go in the last year, and the silver price in net is flat around $15 versus 60 million ounces went in, and we had silver spike up to 50. So we've had about, almost 3.5 times that amount of metal, again, allegedly go into these trusts, which the point being that that's a lot. And another thing, I'll back it into, that was the 20-year. Here's the 10-year. I also find this one interesting in that here, as silver is going from $50, gray one is the price. So you see silver is coming down from 50 to pretty much around this $15 mark for a while over the last, let's call it 8.5 years. All the while that silver has been going down in price, um, again, which you would normally associate with people selling something, yet instead you see this line, a pretty steady upwards, went from about 700 million ounces to now 1.2 million ounces. So almost doubling while the price is falling. So if anyone hears from the Department of Justice on that investigation, come wake me up. Anyway, here are the COT reports from last Friday in case you have not seen them. Interesting trend, both gold and silver. You see open interest down over the last couple months. And here is the short position of the banks, which had really been blown out pretty good there and has come in as well. A similar picture in silver. If we take a look here, again, what was this? Let's say March area there. Again, reducing that short position quite significantly. Open interest as well. So what to make of it? Gee, it's, not an exact science, although what I've taken away from this before, and it's interesting. Generally, once you see the blue, meaning the banks are getting pretty short, you look up there, and often when the banks are really short, the price declines. They buy back those shorts. So you can find these charts in a bunch of different places. These are from Nick Laird's Gold Charts or Us, but you Google the COT charts and just look, match up right here when they got really short. You did see a drop down there. All right, so if the mark goes actually positive, so the banks were flat, and then you did see the beginning of a big rally. And this all kind of held till right around the time when I actually started trading it, which was last year. And that was what was interesting, where the pattern broke for a while. Let's see, I guess that would have been right back here where the banks, started getting short. It just didn't, if I recall what happened, they got to the point where normally the price would have come back in. Didn't happen. Again, that was at the same time there was a large buyer in the SLV. So a lot of these things are connected, and I don't know it's necessarily fait accompli that the banks are going to win. Thank you for those 7th grade public education French classes to get that accent like I did. Anyway, Worth taking a look at, especially the platinum chart is an interesting one where you see quite a high correlation. So certainly getting closer to flat here, at least historically, could suggest maybe that higher prices are ahead. Uh, I still think at some point this whole scheme runs into trouble. And in fact, a couple people asked me this week if I thought the banks care about the price of the metals. And I guess is probably not. In fact, if you can front run something and you just move it up and down, you can win easily either way. So I think my view has just been this is the mechanics, especially they've built that short position up over time. There have been times where they've pawned it off onto the technical funds, and you would have thought, gee, maybe that's a time to run for the hills. Again, we're really extrapolating and simplifying quite a bit. I mean, what each individual trading desk is thinking and doing. Do they see this whole situation? They also probably have some interesting data points that I would love to see and find out about, hopefully one day. That's why I try and bring a lot of people who are just connected with this situation in different ways. I bring them onto the show so that, they can comment, because it's not going to be reported and spelled out in the Wall Street Journal, but at least the clues are there, and you hear a lot of people close to the LBMA and COMEX say the same thing. So lastly, on these COT reports, my friend Andrew Scadden, who runs a Forex channel and is quite more of an expert at digging into these than I am, we're going to get him on the show soon. Got a lot of interviews coming this week, but anyway, just another reason to go down there, hit that subscribe button and the notification bell so you can stay posted, because there's a lot going on in these markets. And I think it's going to be one of those things where at some point the market will move, and then maybe not quite to the same extent as cryptos, but still, it's like all this gold and silver stuff. I mean, the same general theme is in place, yet there's all these intricacies that, I mean, I like to think the fact that I've been doing this for the last 11 years will serve me well once the market pricing finally, especially once gold gets past 1900, and I wonder if we won't have an environment similar to what we saw in the cryptos a couple of years back. And then all of that knowledge, you can't just download it overnight. So that's why, I think on the other hand, yeah, I get it. People, and I'd like to see the prices go up, and I think that'll be exciting when it happens as well. Yet the first mover advantage you get that can't be instantly replicated. There's not a lot of people in the world that understand this, or go. I mean, once the price is going frenetic and they're trying to figure it out, you'll have all of this information to draw from. And I'm not saying just the stuff I share, but the guests I bring on, the other great channels that are out there. So I think it's going to be worth your while. I hope so. I know there have been those days. I'll admit that back in, what was it, February or March, when silver went below $12, and I had a couple people call me and say, gee, if seeing the surge in demand, shortage of supply, and the chain breaking down, that wasn't enough to end this, will it ever end? And I get that. And there are a couple times, I mean, I'd be insane not to wonder that at times. Yet we did see what happened back in 2011, and what's always stood with me is that Ponzi schemes end. And, is there some possible way that we're in the early innings of this? Geez, I hope not. I guess we'll find out. It sure seems, what is it, long in the tooth. Love when people say that. It seems like it's on borrowed time, and I think it's in the later innings. And we'll see what life has planned, because I don't think we're pricing the fundamentals as much, but really, how do you change margin requirements? How do you create EFPs, or whatever ways can the game be changed? That's what you're pricing. But I still think for people who can take a long-term approach, here we got silver at 1550-ish, which is close, maybe not, maybe slightly above, but I would say close to cost of production for a bunch of these miners. So um, we'll see how it goes. Anyway, gonna wrap up for today. Probably went a little longer than expected, but wanted to get you some ETF inflow data, and you can make of that what you will, whether the metal's actually going in there. But I do hope you enjoyed this. If you did, hit that share button. Share it on Twitter, Facebook, or anywhere. If you think if you're finding this helpful and wondering why it's not covered more widely, hopefully others will as well, and will appreciate if you share the love. I certainly do. I thank you for watching. And again, to dig a little more closely into some of these topics, especially the COMEX, the LBMA, and the pricing there, well, here is Dave Kranzler telling you all about it.